Right, so welcome back again to building profitable trading systems. It's been a while coming. All right, so sorry for the somewhat delay in between the first part and this part. All right, so without wasting time, we're going to get into it. So in this particular, this second part, we're going to be looking at liquidity and inducements. Liquidity and inducements. Now, by the time we are done with this, you'll find out why it's so important to pay attention to these two concepts in your trading, whatsoever system you want to build. In the first part, we looked at looking at buyers, various ways that we could get buyers. That is basically to get your direction in the market. So, do you want to buy or do you want to sell? We looked at various ways to get it. We looked at technical analysis. We looked at how to use fundamental analysis. And then we also looked at how to use sentiment analysis. And I said, usually you have a better chance of getting your direction right when there's a confluence between more than one of this. Usually, I like to always involve sentiment in whatever thing that I am doing in addition to the orders. All right, so let's get into it. What exactly is liquidity? All right, so the whole concept of liquidity comes about because big money needs counterparty to their orders. So imagine someone wants to come into the marketplace and sell 50 million worth of Euro USD. All right, so want to convert 50 million from euros to USD. Right, it means that we also need to find someone who is willing to buy Euro USD. That's basically what it means, right? If we don't do that, if we don't, not necessarily that we need to find, but if we don't particularly pay attention to make sure that there is someone or some people who have orders in the market that can mop up what we are doing, what is going to happen is that the moment you place your 50 million sell, the market is going to tank, right? The market is just going to drop. And what will happen is that you are going to get in at less favorable prices than what you would have wanted originally. Now, for any of us who have traded, if you've had the opportunity to trade a really large account in the FX market, you understand this better because you discover that when you're trading your 1K or 5K, you get filled. Like no matter where you place your order, you get filled, right? Because you don't have the orders are usually not large. But once you start trading something like a 200K, you start trading something like a 600K, what you discover is that there is usually slippage in your feelings in all the orders that you feel. There will usually be slippage, there'll be reports from the brokers that you are dealing with, right? So that is because there is not enough liquidity probably at that point to meet the entire stuff that you want to sell, the entire order that you are placing. So for big money as well, big institutions who need to get involved in the market, they need counterparty to their orders. So if you want to buy, you want to make sure that there's enough selling orders, there's enough sell orders in the market or selling positions in the market to enable them to fill their orders. All right. So I said, hence, they always seek liquidity to enable them to fill their orders without distorting the price. So how do they do this? Because there are a couple of ways they do it. Usually, one is that they simply just get the order book from certain brokers, right? So your data is sold off by certain brokers. I don't know how legal that is, but it does happen that a particular broker could just sell their order flow, right? They could sell the orders that their customers have placed to these big institutions, and so these big institutions know around what points there's likely going to be a whole lot of liquidity resting, and so they could place their own orders. But usually, or more commonly, what they usually do is to anticipate where traders have their pending orders. Now, this could be pending orders, could be your stop loss, it could be your take profit, it could be limit orders, it could be buy stops, sell stops, and orders. So anywhere that there are orders, that is where liquidity is going to be hanging around. All right. So remember, what we are trying to do is we are trying to look for where money is resting, where we can find counterparties. So if we want to sell, we are looking for where do we have buys, right? If we want to buy, we are looking for where do we have sales, so that that way it doesn't distort the price whenever we introduce our own orders. Now, if they cannot find this liquidity ordinarily, all right. So if they look at the charts and they want to engage and they cannot see where sufficient liquidity is going to be resting, then what they might do is to engineer inducements. We'll see what inducements are. So they engineer inducements to get other traders on the sidelines to get involved. All right. So that takes us to the subject of inducement. Don't worry. Let's be through with this theory and then we'll get into the charts to see how we'll use this in practical terms. So inducements occur when big money players try to get other traders to get in on the wrong side of a move. All right, so I'm going to take that slowly again. So inducements happen when big money players try to get other traders to get in on the wrong side of a move. So when they usually need to place a very large order, a relatively large order, and there seems to be an absence or insufficient opposing liquidity needed to pay their orders, they could create or engineer something that we call inducements. All right, so this is usually done in a couple of two ways. The first one is to do what I call engineering a false breakout. All right, so let's imagine that you have um, usually some people create. I remember when a couple of years back I used to trade a London breakout strategy, which is basically framed around the fact that the first 1 hour candle, all right, you're looking for it to break out either to the upside or to the downside. So what can they do? They could basically say, all right, so we want to sell. So what are we going to do? We are going to get people to buy. So that is what it's all about. We want to sell, but we need people to buy. So what would they do? They engineer a false London breakout to the upside, right? They could engineer a false breakout of the daily range. So some people, instead of just the London breakout, they are waiting for the high of the day to be broken. Either they're waiting for the previous day's range to be broken. Either it is broken to the upside or it is broken to the downside, and then they want to ride the trend, all right, to ride the momentum to that direction. So what could they do? Basically, just take out yesterday's high, trigger those people's orders, and then reverse. In some cases, some people will say, okay, we're going to wait for a 1 hour close above the high of the day to make sure that they're not faked out. What would they do? They will close one candle above the high of the previous day and then basically take it down the following candle or a couple of candles later. So they could engineer a false breakout. The second thing they would do, or they could do, is to engineer a shock trend against the direction they want to go. So sometimes you see the market uh, where in a downtrend, but there will then be what some people will say is a correction, right? So we'll see a mini trend begin to form against the trend. And so what happens is people who have been trying to catch the bottoms or who try to call bottoms will then see that as a beginning of the reversal of the move. And what happens? They jump in on the move. Once they jump in on the move and then begin to buy. So let's assume the trend is in a sell, we're in a bearish trend, and then price begins to buy. It buys first day, buys second day, by the third day still buying, people get convinced, okay, the trend is now changing, and what happens? They all get in and basically they reverse the move and continue the bearish move that was in place already. And then the last one is engineering volatility. So usually they will do this a lot during news events. This one is, it could still happen, but I think it's more commonly done during news events. So what will basically happen is they could buy, all right, they are the same people. They want to sell, but they start off by buying, throw in a big large order, buy in the market. What happens? That drives the price up. Remember, we'll talk about distortions. All right. So they drop in a huge order, knowing fully to distort the market a little bit. And what they will do is that the moment they have thrown in those buy orders, the market rallies, right? They know that's exactly what is going to happen. The market rallies, and then get other traders. So other traders who were not willing to participate in the market before sees that huge spike. Even those who are trading volume sees that huge spike in volume. What do they believe? They believe, oh, the market is going to be going up. And then what happens? They basically begin to place their sell orders gradually, right? They begin to now place their sell orders, begin to place sell orders, begin to place sell orders gradually in such a way that it doesn't distort the price. So they are placing it as they are buying, they are selling, they are buying, they are selling, they are buying, they are selling, they are buying, they are selling. So what happens is that at the top of that bullish move that has just happened, there's now going to be a whole lot of buys and sells, buys and sells, buys and sells. So what has basically happened is that because there's both buy and sell coming in, buy and sell coming in, you just see the price drop just slightly. So just move up slightly, drop slightly, move up slightly, drop slightly, move up slightly, drop slightly. And once they are done filling their orders, what happens? They close their buy orders in profits or their buy trades in profits. Price basically does what? Price tanks because the bullish momentum is gone. So what have they just done? They've used hedged orders. All right, by hedging the orders, buying and selling, they've been able to engineer volatility in the marketplace and basically get their orders placed. Now, the simple truth is, it's not really that they're after your money, it's that it's business for them, right? It's business for them. They need to place their orders and they need someone to place their orders against. And so they are willing to do whatever it takes to get their orders placed. So, how do you use this whole concept of liquidity and inducement? So, that's going to be the last thing we'll look at, and then we'll get into the chart. So, the rule of the thumb is basically to try to think and trade as a big institution, right? So, one of the ways that I use is basically to try to trade against opposing liquidity within the context of a bigger trend and move. And I'm going to illustrate this. This is exactly what I'm going to be illustrating in our examples. So, how are you going to do this? So, imagine that the trend is an uptrend. All right, we are in an uptrend. So, we are buying, we're in a bullish trend, right? And then you then begin to see prices coming lower, creates a fractal low. So for those of you who have followed me for a while, you know I usually like to use the fractals in my trading, right, on H4. So when you see those fractal lows form, what does it tell you? It tells you there's a turning point. Now, what is going to happen is that basically some traders are going to jump in and then begin to think that's the bottom, begin to buy from there. Some others will say, no, that's not the bottom. The trend is still bearish, it's still going to sell. So they'll be waiting for a breakout. So price drops, but then um, price continues to move up a little bit. Then price comes down and breaks that low. So what happens? They now believe those ones that were not willing to play initially now sees this that okay, yeah, the downtrend is about to, okay, sorry, I've gotten the whole thing mixed up. So I'm going to just take it again. All right, so we're in an uptrend, price is making higher highs, higher lows, and then we go to H4 and then we'll see price just basically calm down, right? Create a fractal low, and then price begins to go up. Early buyers think they are going to buy, all right, and make a whole lot of money. And then what happens? That doesn't happen, and then price comes back and then begins to take out that fractal low. So people who were sellers or who try to catch the start of a sell move see that okay, it's like the trend is changing. There's been a change in structure because they are not paying attention to the higher time frame, uh, to higher time frame alignment, right? So they begin to sell, all right, and then basically what happens? They've taken out the early buyers, they've induced sellers. Remember, for the early buyers, their stop loss is actually a sell, right? So the buy stop, the sell stop that they have as their stop loss. In case you don't know, your stop loss when you are buying is a sell stop. Think about it, right? I'm just give you a moment. Think about it. You are buying, right? If you are going to get out of the trade, you can only get out of the trade by selling, right? You can only get out of the trade by selling. If your sell order is below current market, what is it? Sell stop, right? So what you have is a sell stop. So they are going to trigger the sell stop of the early buyers. They are going to trigger sell stops of people who want to sell because they feel there's been a breakout to the downside. And what happens? All of them are now wrong, right? Markets makers basically do what they want to do, pair their orders against those buy guys, introduce slightly bigger orders. The market begins to rally as those guys are obliterated. So the first thing you want to do is to try to trade against opposing liquidity within the context of a bigger trend or move. So you have a higher time frame, say the daily. I like to use the daily personally, and then you go to lower time frames to see when there is a trend that is contrary to the trend of the higher time frame, and then you want to go opposite to that trend, right? So that's one way you could do this. The next way you could do this to apply the concept of liquidity and inducement is to track these manipulations by studying volume. I'm not going to talk about this so much. I'm going to give you ideas you could use in the FX because we have some ways that we actually try to do this. And we're also going to give you broad strokes that you could actually apply. So the first one is to note when you have huge moves without accompanying volume. So you have a huge move either to the upside or to the downside, and there is no accompanying volume, right? You're not seeing that same move in volume. It makes it likely a manipulation, right? It's likely a manipulation. It's going to fade away. Now, the next one that you would usually see is if you have a huge spike up in bullish volume without a corresponding spike in price in the same direction, right? It could be bullish, it could be bearish volume. Actually, it doesn't have to just be bullish volume. So you see a huge spike in volume, either bullish volume, and then you're not seeing price also raise up the same way. It could suggest that someone somewhere is basically just using limit orders to absorb other bullish volume. So that's one of the ways that you could see sometimes when they are using hedge orders, right? So when someone is trying to use the hedge method of manipulation, all right, you will see this. So what will happen is that the first huge spike in volume, you will see that price will follow it. But subsequently, you will see that someone is buying, but the price is not moving as much, right? So you will see one first huge spike. I'm using the bullish kind of manipulation right now. So they want to sell and they want to manipulate people to think the price is bullish. So what do? Place huge orders, buy orders, or place huge buy trades. Market spikes, volume spikes, right? And then the next thing that you have is they place a huge buy order. At the same time, they place a huge sell order. So what happens is that the two of them cancels each other. However, the sell order is placed using sell limits, which do not quickly reflect in price as much as when you're using stop orders. That's a story for another day. So they're aggressively buying, aggressively buying, and then at specified points they have sell limits that they have put in place. Almost all methods of tracking volume has an issue with working with such type of things. The volume would not immediately show it. It will not show that sell. But what you just see is that there's a huge spike in volume to the upside, but price is not showing that same huge spike. That is an indication that someone could be absorbing all the buy or the aggressive buying using limit orders, and very soon the price will revert back to the downside. All right, so let's see this in the price chart. I'm going to be talking about the first one. The second one, I'll leave you to go figure that out on your own. You could use there's several volume tools out there that you could use to try to study that. All right, so let's get into it. All right, so what I'm going to do is basically going to run through a couple of examples. All right, so let's get into it. So we'll start with one that just happened just yesterday, and that was on GBP USD. So before we do this, I've added my fractals. Remember what I talked about confluence? So next I'm going to add, just going to use the things I've taught in the course so far. So I'm going to add my envelopes. So for this, I'm going to be using 21 method linear weighted deviation 0.5. And then we're going to click on OK. All right, so the first thing you can see is you want to ask yourself, what is the order flow? All right, what's the fractal order flow? We could see price broke this to the upside right here. All right, and since then we've basically been bullish. Now, if we look at what happened here, remember when we're using our envelope, we want the previous day to close above the lower boundary. All right, this is even closing above the higher boundary. Now, a trick I could give you is that usually you want if you are buying, you want the lower wick to be within this envelope, right? That is what gives you the best setups. You want your lower wick at least to be within below this upper boundary, right? That shows you that you have a bit of a good correction before that move is taking off. All right, so let's go to the H4. So if we go to H4, what we can see on the H4, right, you can see this. Let me drag this here. All right, so price came in. All right, we had this fractal low formed within the week. Remember, I always wanted to form within the week. So what does this indicate? Some people started buying here. And so some people would have seen this, oh, is a buying taking place. Some people even came during Asia, tried to buy. And then what basically happened? Remember what I said? They came here, triggered them out. They would have been taken out. Where would their stop loss be? Below this low. So they came, took all of them out and bought. So let's go to H1 and see how we would have taken that. So for those of you who watched my markets preview where I talked about my entry methods, you will see this very clearly demonstrated. So this was that day, Monday. All right, so this was your Friday 21st and then 24th of February 2025. All right, so this was the candle responsible for creating that fractal low. They basically come during the Trade Experts European session and basically take that guy out, all right, and close right above. All right, watch that candle. So the lows takes it out and then closes above. Now this is GU, minimum SL for GU based on the ATR, based on the average true range of the pair is 15 pips. So that's our minimum stop loss. So anytime we're trading, our minimum stop loss is 15 pips. For pairs like EU, UCHF, ECHF, we use 10 pips as our minimum stop loss. For things like GCHF, which tend to have a greater range and spreads tend to be larger, we use about 20 pips. All right. So that is our entry candle right there, the close of that candle. So would have taken just a moment, taking the fibs, and would have drawn it like this, the bottom of that candle, and we are looking for 15 pips. Not just to waste our time, just do it the way I would have done it from just backtesting. Usually I would have built things to help me backtest, but let's just do it that way. So 15 pips, right? So this week was just about 7 pips. So your stop loss would have been somewhere here, right? So 15 pips SL. So our TP1 will be 15 pips up. So your TP would have been hit somewhere here. right? Just on the following candle, your TP1 is hit, and then we are targeting 3R for our TP2, and that is about 45 pips. Your TP is fully delivered right there, right? So that is how you could have played that. So remember, what we're doing is we're trading against opposing liquidity within the context of a larger move. So we identify that our trend is up, right? So we saw our envelope is suggesting our trend is up. We are seeing that the fractal OF said our trend is up, right? So what we basically did was to come and see where was, if I was trading like an institution, how am I going to do this? So I saw a fractal form, take it out, go above, close back above. That is the entry, and then you begin to write. Sometimes they don't do it like this. Sometimes you're going to see this candle close below this completely, right? This one close below it, but then this one will do something like this. Take out the lows of this candle, close back up. That will still have been an entry, right? That will still have been an entry. But personally, this is, in this particular case, this is our entry, right? I will not take this entry except for if it is lower than this current entry by at least 5 pips on GU, or 3 pips on EU, or those 10 pips minimum stop loss, guys, right? So let's look at another example. Let's look at, I think there was one on HF. There was one on HF last week. All right. So if you look at the fractal OF, it looks a bit all modeled up, but just follow it. So this was the last fractal low, and this was broken to the downside, right? Price closed below it. Price closed below it. So and then since then we've not had a break to the upside. It tried here, but it didn't close above. For it to be a break to the upside, then they must close above it. Price didn't close, so we are still bearish. Now, when we are bearish, we want price to, and we are looking to sell, we want price to close above. We want price to close below this upper guy, right? We want price to close below this upper guy, which it did here. So we are going to be looking at the 19th, if I'm not mistaken. Yeah, the 19th of February. So let's go to H4, and we are tracking HF on the 19th. So we can see this fractal high that formed here, right? So remember what we are doing. We want to trade within the context of a larger move. So we've seen we are bearish, right? This fractal high has formed. What are we anticipating? Price is going to run through it and then give us a reason to sell, right? So price comes to do that right here. And then we are going to be looking at this within particular times. So let's look for HF, and we are going to the 19th, right? So you could see this was your Friday, this was Monday, this was the high that was responsible for that fractal high. So what are you expecting? You're expecting price to come run through it, right? So clearly you see that again within the Trade Experts European session. We're going to talk about time and price in a future video, right? So see that happen here. Price takes it out, closes below. That is your entry right there. This is HF. You're going to be using a minimum stop loss of about 10 pips. Minimum, not maximum, right? So minimum. So we need to check. I usually want to check, is this more than 7 pips? If it is, then I'll be drawing out my fib tool. Because what we basically do is that we'll mark up the range of that, not the range, we'll mark up from the highs if we're looking to sell, from the high of that candle to the close, and then we're going to add 50% as our stop loss. All right, so yet again, anyway, let's just say it is 2 candles. So two candles, hit your TP1, and then took a couple of days, and then hits. So took this whole this and then following the basically hits your full TP, and that's how you would have taken that again. So several opportunities presenting themselves. Um, I think that would be that. I've taken a buy example, I've taken a sell example. So I'll leave you to go play around with this. Or maybe let me look for one more example to use. Right, so let's look at this example on UCHF. Right, so you could see this was the last fractal that was broken to the downside, right, before this particular move right here. So if we go, you can see that was so we are looking at the trades starting from around the date, so like the 17th to the 19th or thereabout. So let's go to um all right, so the first fractal high was created right here. So this is a good example of creating a trend, a mini trend against the originally intended direction, right? So you could see the slow build up here, and everyone would have started thinking, okay, we're getting breaks, that there is a change of structure. If you aren't convinced by the time they broke it the second time, you would have started getting ready to take it long, and then they basically reverse the whole move. So let's go to 1 hour and see. So they broke this one. This is 4 a.m. now, trading time. So maybe from 1600, we'll see if it is still within our trading time, and then we'll take it. All right, so the 18th and then the 19th of February. All right, so okay, my markups for this are even still here. You could see this was when this was 7 a.m. So now within our time frame, start looking at it for 8 a.m. And then these are called 1900s. So when the high was taken out, 1900 is also outside our time. We stop looking for its 1800 candle. All right, so we would have come here, and basically what happened is we would have gotten this first one. All right, so what happened? Price had closed above. Remember, this is the 17th, and the fractal closed above it, closed above it, closed above the previous day. So once the fractal has been closed, they've closed above the first fractal. I basically just start looking at the previous day's highs. Once they take out the previous day's highs, I start hunting. So again, it closed above this. So if you're a breakout trader, you have taken this either during the exchange session, you would have looked to trade the breakout to the upside, looked like they were going down, and then started coming back up again, broke it the second time. You are happy, okay, yeah, the buy is going to go. And then we get this price takes out this candle's high, closes below. This is within Trade Experts European session, right? Takes it out, closes below. This is our first trade. All right. And then basically 10 pips SL. So you would have hit your TP right there. And then um, ideally, you shouldn't have been taken out. So on some brokers, you would have been taken out because of spread. Ideally, or most good brokers with good spreads, you would have been taken out. And then sometime later, you come to get your 30 pips. However, this was taken off using my USD method where I used the USD basket to trade. So this was my own entry. So if you had for any reason missed that one, this was the entry, right? Took the trade. If I take my fibs, I'll drawn your candle like this, right? And so that was where my stop loss was there. drawing fibs sometimes in empty is annoying. All right, but basically you get the idea. So TP1 somewhere here, TP2 somewhere there, and then basically delivered uh, within 2 days. The whole thing was hit. So I think that's enough example so that this video doesn't get too long. So basically, you want to get your trend, go to daily time frame, probably look at two things. I've given you two simple ways to look at it. Fractal wave, combine it with your envelope, and then want to trade in the direction of that trend. And so you go to the next time frame, which is what I like to call an intermediate time frame, which in this case is the H4. And then you want to wait to see when an inducement occurs. So you want to wait to see when an inducement occurs. So remember how we looked at the inducement? You can go and look at it. It could be in the form of a false breakout. It could be in the form of engineering a trend against that direction. So we're looking to sell in the higher time frame, and then they begin to buy on the lower time frame or the H4. Right. So the daily is giving you a sell, H4 is then buying. All right. Then you can begin to look to go contrary to what the H4 is doing within the concepts of time. Right. So that's going to be that. The next video, we're going to explore time and price in detail, as well as entry techniques that you could use in your trading. Thank you for watching, and if this content is something that you like, then please subscribe to the channel, comment. I would like to hear from you. How have you found the content so far? Do you think it's something, is there something you want me to talk about, shed more light on? Go drop it in the comment section. I would like to hear from you. Please also do share the video with those who you think it will be beneficial to, and keep winning. That will be all from me. Bye.